Hi, and welcome back to another Options for Newbies video. So today we're going to cover, it's a bit more of a complex, well, it's not really a complex strategy. It's a riskier strategy. Okay, so anybody who's a beginner or new to options, obviously this is not going to be your go-to option strategy. But I'm covering it. I'm trying to cover as many different option strategies as possible. So when you do get there, then you're comfortable with the concept of it. Okay, so today we're going to cover the short strangle. Okay, so a short strangle, you're selling an out of the money put, and you're selling an out of the money call. So for that, you're collecting a premium on both the put and the call. Okay, so like I say, it's a high percentage winning trade. However, uh, it does have a lot of risk to this particular strategy as well. So let's get into it. So the risk and reward of trading a short strangle. Okay. So of course the max gain is the credit or premium you collect, right, by selling the calls and the puts. Your max loss, however, is theoretically unlimited. Okay. So obviously, if the stock, makes a huge move up or down and goes beyond your strike prices, then you're going to lose money on that. All right. So obviously, for the strategy, you want something that's fairly range bound, not too volatile, something that's not going to move. And you can put the strikes out really wide. Like you can have a lot of movement on the stock, right? But you just don't want it to you don't want the market to tank, or again, you don't want the stock to double, because you could get yourself into a lot of trouble on this strategy. Okay, so let's take a look at an example. And again, this is an example, not a recommendation. Okay, just for educational purposes only. So let's look at we're going to look at the SPYs. Now, these prices are as of October the 16th, 2017, based on the close of the market day today. Okay, so if we sell 10 contracts of the December 261 call and sell 10 contracts of the December 240 put, again, so that you can see how far away this call is a little bit closer, but you can see they're fairly well off. It does give you a lot of wiggle room. Okay, you're going to make money if the stock is within those strikes. So you're looking at you know 21 $21 move in there. So like I say, you got a lot of space to play with. Okay, so your credit on this is going to be $1.86, so $1,860, which is your max gain. Of course, your loss is indefinite. So if it goes, over that over $261, you're just starting to lose money. Again, goes down below 240, you're going to start losing money on this one. Okay, so let's take a look at it on let me see, on the demo account here, on my Thinkorswim paper money account. Okay, so here we are, 261 call, 240 put. So let's look at the probability of these being out of the money. Okay, so if we look at the 261 call, so the probability of being out of the money is well, pretty much 80%. Okay, that's based, again, based on today. Obviously, those percentages are going to move as this stock moves around. If you look at the put, 85% chance of out of the money. That's why I say this is a higher percentage winning trade. Okay, because and as it's trading along too, you can still roll these things out. So if it starts to get a little bit closer, maybe some time's running out on this, you can roll out the strike a little bit further, collect another premium on that. Okay, so yeah, so it is a higher winning percentage trade, but again, bear in mind that there is that tremendous risk if the stock makes a huge move on that. So you have to be careful with these things on there. But like I say, it can be a good income generator if you if you know what you're doing, and if you feel comfortable with taking on that risk as well. Okay, so anyways, it's I just wanted to do a short video on short strangles. They're I've used them before. So like I say, it's a great income strategy on there. Okay, so anyways, hope you have that's all I have for today on this. Again, have a great day, happy investing, and bye for now.